Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you heard the man. You are listening to the Mr. Mortgage Show, and if you've got questions and you want answers, you can call or text those questions to Jen, my producer, and you can reach her at 855-462-7292. That's 855-462-7292, affectionately known as the Anytime Hotline, because when we're live in the studio doing the show, it rings here, but we also push that to a question line at my office. So during the week, if you have questions, you can always use that number, 855-462-7292. Hey, Jen, I forgot to check in. Good morning.
Good morning, Mark.
How are you? Are you having a good week? It's been a good week for me.
It's been a great week, Mark.
Yeah, it's been a great week for me too. Man, I'm so happy you're with us. I know you've already got some questions popping over there because I see you jumping around. But hey, before we get to those, guys, I just wanted to touch on that Federal Reserve Brookings Institute comments that I alluded to in the opening of the show. So at 1 hour and 10 minutes into this diatribe, there was a question from the audience about interest rates, and they were talking about green energy initiatives and a lot of other things, but housing was a component of that question, but not a direct question. But here's something that he said, which I thought was quite interesting and I wanted to share. He talks about, yes, the low interest rates caused a bubble cycle, meaning rapid appreciation. And he feels like housing has to go through the other side of that. And his words are, we're seeing that now. So higher interest rates are slowing demand. Now, where things shuffle from here, he didn't allude to, but this is what he said that I want everybody to grab onto. He said, fundamentally in this country, moving forward, we still have a significant challenge with supply and demand. That equation, and you hear me talk about it all the time, and if you want to hear more of that, go to MrMortgageRadio.com. There's many episodes that reference supply and demand. But he's saying that his comments alluded to, in this country, it's expensive and it's slow and it's tedious for builders with zoning and permit and land acquisition costs to bring new housing units to the market. And he sees long-term pressure on the supply and demand equation. And that means, guys, at least the way I interpret it, is that there's no free fall from here, because until we're oversupplied, prices have no reason to go down. The cost of money only slows demand. And guys, if you think high interest rates mean lower prices, think about it this way. If you go into the convenience store, the electronics store, the grocery store, you go online, it doesn't matter. You go shopping and you find an item. And let's say that item is $75 and you take it up to the register and you're going to check out. That price is $75 whether you pay cash, whether you use your American Express, which we know you pay every month and you just pay an annual fee. There's not interest unless you have a business card. Or you're going to use your Visa or MasterCard, which could have 23, 24, 26% interest. That cashier ringing you up doesn't say, oh, you're going to pay with that high interest credit card? Yeah, the price is $50. Oh, you're going to pay cash? The price isn't dictated by the cost of the capital used to acquire that, in this case, asset when we're talking about real estate. The only thing cost of capital does is quell demand. And the hope is that increasing interest rates will quell demand to balance the market to slow appreciation. He was pretty clear that he doesn't have intent on crashing the market. Now, that could be a byproduct of the higher interest rate environment. But my point is, higher interest rates only intend to slow demand. And if you think about it in that example I just gave you, whether you use your high interest rate Visa or MasterCard or cash, that product that you're purchasing is the same price, regardless of the cost of capital. So I hope that helps. I was thinking about that on the drive into the studio this morning, and I thought that might be a good analogy to kind of just paint it through a different lens in everyday circumstances that we deal with. But hey, Jen, I'm going to throw it over to you so we can get the questions rolling. What's question number one?
Kim is asking, we are retired and earn very little income, but we have a nice amount of money in the stock. What are the options for a mortgage if we buy a rental property?
That was Kim? Okay. Hey, Kim, that's a great question. So we have a loan program that we use, we talk about it quite often, called the landlord loan. And the landlord loan requires you to verify assets, and we review your credit. So assuming you have decent credit and you've got enough verified assets for the down payment and then the reserve requirements. So typically you're going to want enough cash on hand to put 20% down on the purchase and then have 6 months additional cash for the expenses of that property. So that's what reserves are when you're being underwritten for a purchase. So if it's, and I know this scenario only works in fantasy land, but let's say the mortgage payment, principal, interest, taxes, and insurance is $1,000 a month. If you've got the 20% plus $6,000, your assets are fine. Your credit, assuming that it's good and you know decent credit score, you're okay there. Then we're looking at the income produced from the building, or the home, or the duplex, or the fourplex. And as long as the rental income from the property, to use that fantasy land example of a $1,000 expense, if the income is $1,000, just a 1-to-1 ratio, no profit, even money, that's fundable. In the old days, we needed 1.25%. It's called debt service coverage. DSCR is debt service coverage ratio. Sometimes you'll hear the landlord loan referred to as a DSCR loan, and that's what they are alluding to. And in the past, it was required that you had, in that example, $1,250 in rental income, $1,000 a month in expenses, and then that was considered cash flow even and fundable. But the landlord loan allows you to go a 1-to-1 ratio. And here's one other thing I want to throw out, and if you guys have more questions about this, just call me, 855-462-7292, or call or shoot another question to the text line, and we'll keep this going. But the landlord loan has a component to it that's interest only, which is super exciting. So an interest only component for the first 10 years, and then it converts to a 30-year fully amortized loan. So it's a 40-year loan, 10 years interest only, 30 years amortized starting in year 11. So what that does is allow you to maximize your cash flow in the early years. And there's no obligation to keep it until it adjusts to a fully amortized loan. You could sell it, you can refinance it, you can do whatever you want with it, but it gives you access to maximize cash flow by using the interest-only component for the first 10 years. So super exciting for investors. And guys, if you're an investor, cash flow is the only equation that matters, because you want to make sure you're throwing off as much positive cash as possible, regardless of sales price, regardless of interest rate. And the interest-only component associated with the landlord loan is a great way to do that. So great question. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this break. We're going to take more of your questions and deep dive the data. Sit tight for more of the Mr. Mortgage Show.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.